Hello, everyone, and welcome to another installment of Investing with IBD. It's July 12th, 2023, and I'm Justin Nielsen, your host, and joining me, as he always does every week, Arusha Peiris, an O'Neill Global Advisors portfolio manager. How are you doing, Arusha?
Hey, Justin, I'm doing great. I'm very excited about our guest today.
Yeah, this is a returning guest that we have, Simon Erickson. He's the founder and CEO of Seven Investing. Really, what's great about having Simon on is we sometimes will focus so much on the charts, but Simon really likes to get down into the fundamentals. And in this episode, we're going to be talking a little bit about how he finds those hidden gems. So, welcome to the show again, Simon.
Justin, it's my pleasure. It's always nice to be here chatting with you and Arusha for your show.
Yeah, it's always great having you, Simon. So, first off, let's get a little bit into the market. We'll just kind of give a quick overview of the IBD take, and I mean, what can we say? This has been a very well trending market in the Nasdaq Composite. In fact, I was doing some of my market school stuff, and we have this living above the 21-day moving average line signal, and this is the longest that we've been moving above that 21-day moving average line on the Nasdaq Composite. The most weeks up above that line since 2017. So this is kind of getting into unusual territory, how well we've been trending. And one of the things that's notable is that we just kind of broke out of this little consolidation area. Nasdaq is looking great. We have a little bit more participation. S&P 500 is right there, also kind of getting into recent new high territory. But the Russell 2000, which was kind of lagging for a while, that's started to perk up a little bit. It had a little rough go over the last couple of weeks, but kind of broke out of a little handle, if you want to call that like a cup with handles. So, real quickly, Arusha, let me get your take on all this.
Yeah, I think this is in many ways the beginnings of a classic bull market, right? The market just keeps crawling up. It's climbing that wall of worry, and everyone who waits for a pullback and they're waiting for a decent pullback, it can be a little shallow, kind of like what we're seeing right now. And we'll see if it getting into newer highs right now is kind of emerging out of the pullback is over. But this is almost classic. There are a lot of people who are still bearish on the market, who don't believe it, and they might be right. But in the end, the most important thing is the market is always right. And right now, all of the stocks that we like, these growthier type of stocks, they are acting pretty well here. So this is our type of market, and it's just classic. It's just like what we read in the book, what we've always heard Bill O'Neill talk about. When you get these signals, try to get in some of these best stocks and give them some time to work, because they can go up a lot further than you can imagine.
Yeah. So, Simon, what's your take? Because I know a lot of times when you're looking at stocks that you're looking to invest in, a lot of times you're really digging deep into the fundamentals, and I guess a lot of people, the biggest concern has been the inflation, the recession fears, soft landing. Are all of those still kind of big weights in your mind, or what is your take on the market? How are you approaching the general market here?
Sorry, Justin, but have we said AI yet in this conversation?
No.
I feel like I don't have any conversations anymore where we don't say AI in the first 2 minutes. I was waiting for it.
I'm so glad you mentioned that, Simon. Otherwise, people would have tuned out. So thanks.
So reflexive to that. It's uneven distribution, right? It's the big getting bigger, the rich getting richer. When you look at the S&P's overall return, 16.7% for the year, seems pretty good, right? But then you look at what's at the top of the market, what's really driving all of those returns. Apple, largest weighting in the S&P, 7% weighting, up 45% year to date. Microsoft up 39%, Amazon up 53%. Number 4, NVIDIA up 190%. But if you take out the top 10% of the S&P 500, market weighted index, right? But you take out the top 10 percentage of the constituents, the actual S&P 500 as a whole is actually negative in year to date 2023. If you take out those largest at the top 10%. And so this supports what Arusha just said, that I think that there is a bull market that's still waiting and has legs. We've seen there's money going into the biggest, safest bets into this, but the smaller or mid caps that are similarly participating in these long-term growth trends, there's still a lot of money on the sidelines that's just waiting for opportunities and equities in that class as well.
Mhm. Well, to that point, I mean, this week was a good example of that. We had a couple days here where the NASDAQ composite was up decently, the NASDAQ 100 up even more, but the NASDAQ 100 equal weighted QQEW was blowing all of those out of the water as Apple and Microsoft and a lot of what we've been calling the Magnificent Seven, those biggest heavyweights, as they pulled back a little bit. Um, you know, it seemed like the breadth expanded a little bit. And one of the things that we look at is the advanced decline line. So in MarketSmith, if you put in GMIAB, you can see the NASDAQ advance and decline line at least has perked up a little bit. This is a 10-day moving average line, that pink line on the advanced decline line. And you can see where we've had a couple times where we've started trending above that, really couldn't last for very long, but here we are, hopefully getting an improved breadth issue here. So does that make you feel a little bit better that it's not just going to be 5 stocks carrying the load here?
There's still so much money that's parked on the sidelines, right?
Yeah.
Last that I looked, it was $5.5 trillion of U.S. assets that are in money market funds. And I haven't seen the June numbers yet, but I did look at the fund flows in May, and we saw 151 flowing, more money flowing into money markets, even still. It hasn't gone into equities. There's still a lot of hesitation. We're starting to figure out, what's Powell going to do? What's going to be the next head nod of the Fed? Are we out of the woods yet, or is this just kind of a temporary blip? I think that once those questions start getting answered, once there's a little bit more comfort of the macro economy, that's where you're going to start seeing, other than the just safest, largest names at the top of that list, getting a little bit more love in the equity markets.
Yeah. It's so funny.
Yeah, we are still getting a little bit. Well, we are getting more participation, though, in my opinion. I mean, if I look at the XLI, right, the industrials,
Yeah,
they're starting to hit some new highs. Even energy is now starting to come back. If you look at a Schlumberger, that's had a very, very strong last couple of weeks here.
or just look at
Caterpillar,
OIH, the
yeah,
OIH
exactly.
which is the
Yeah, the oil
field
services.
services, oil and gas. I mean, that looks very strong. But
So that part's encouraging. Where maybe a few months ago, definitely it was the Magnificent Seven, and then it's just slowly kind of broadening out. But now you're starting to, and energy during that time, remember, was starting to fall apart. But now you're starting to see a number of these other areas start to come back, and so there are a little bit more options coming in there. So which leads to like maybe a little bit more money is slowly coming in the market. But Simon, I totally agree with you. It's there's still plenty of money on the sidelines.
But Simon, do you think what you were saying with money markets kind of being a little bit more attractive? Certainly, the rates the rates are a lot more attractive versus what we've seen in a while, and especially after you get beaten up by a bear market. Uh, 4% starts looking really attractive as opposed to -20. So, how long, in your experience, does it kind of take for that to kind of get people off of the sidelines, get people out of their money markets, especially if they just piled into them not too long ago?
Jerome Powell cannot cough or sneeze without somebody freaking out and being very concerned about what he just said, right? It seems every single word is so scrutinized, but he's sticking to his guns on 2% target inflation, right? And that's not going to be something that is easy to achieve, but it's also hard to micromanage the economy. You've kind of got to set a stake in the ground and say, we're going to go with this and we're going to keep pushing for it until we get there. And so I think that we've seen improvements. We kind of see these updates and we see that we're making progress, but it's certainly hard to say we're completely out of the woods. I still think that there's a little bit more macroeconomic pain perhaps in the second half of this year. I think we're going to see unemployment continue to tick up. We saw it in the tech sector. Tech sector's laid off for 100,000 employees within the last calendar year. I think that maybe we're going to see a little bit more on that front, but I think that there's going to be a little bit more of a little bit more contraction of the economy. I don't think it's completely out of the woods just yet, and it's just time to start throwing parades and parties again.
Right. Well, but it's certainly not affected the labor market yet. I mean, last week we had the ADP, and then that was followed by the jobs report. Not as strong as the ADP, but still labor market, pretty tight. And Arusha, what was your take on the 10-year Treasury yield this week? I mean, we did see that pop up above 4%. For the 10-year Treasury yield, that's at 0 TNX on MarketSmith, and then it kind of, well, especially today, really took a downturn. But still, I mean, when you look at how far it's come, that's quite a ways.
So Justin, I put the 10-year on a monthly chart here, and so if this were a stock, I'd be pretty bullish on this stock. It looks to me it's a really strong uptrend, and it's just consolidating there, and looks like it wants to set itself up to go higher, even though even today with today's pullback there. So this kind of tells me that rates potentially could go even higher, and maybe it hits a point where they become more of a headwind for a number of these stocks that have been doing well.
Mhm. And then just to kind of tie a bow on this segment, looking at the NASDAQ again, as I mentioned, we've been trending above that 21-day moving average line for a while. And I guess the question now is, as we kind of get back to these highs and, the 14,000 level, are we getting extended? Do we need more of a break? As you said, I mean, we had that pull back to the 21-day moving average line. It wasn't much. Do we need to kind of get through the summer doldrums? And is that what it's going to take? What do you think, Simon?
I think that we've got a lot more good news coming up. It just maybe the quintessential example or the poster child of this is NVIDIA that just guided for an $11 billion quarter here in the second quarter. The all-time high, when you issued that kind of guidance, that's not, and they said plus or minus 2%, right? That's not just throwing darts out there. I mean, this is a really big shift in the enterprise, which is directly related to AI and the NASDAQ, like you said. Go tech. There's a lot more growth to come here.
Yeah, well done, Simon. Putting AI in one more time, just to kind of, in case anyone's playing the drinking game at home and taking a shot every time we say AI. What about you, Arusha? Your take?
I think that we a lot of times at the end of July, kind of like what Joe Fahmy was talking about last week. A lot of times at the end of July and then through August and into September, the markets do have a tendency to take a break. Now, the one exception and this is all anecdotal and just kind of from my own experience, that one exception is it's been that first year of a bull market where the markets have been able to kind of power through and they don't pull back as much during that time. So if we are in the beginning of a new strong bull market, the pullback shouldn't be too bad. But that being said, we're starting earnings season at the end of this week, and we're going to really get into it in the next few weeks. And when those cards come out, anything can happen. So you really do have to be prepared for everything. And I think the biggest thing, it always comes down to risk management, right? The biggest thing is don't buy extended, as you said, Justin. Don't feel like if you missed out on a number of these stocks that you have to run in and buy them right now. Be patient, let them set up again, and manage your risk.
Mm-hmm. And I always think of when people say sell in May and go away, and how the summer don't expect anything. I always think of August of 2007, where we got that follow through day, and I was not having a great 2007. But if I had missed that follow through day in August, September and October made the year. I mean, it was such a strong end to the year. If you missed that, you kind of missed out on a lot of opportunities. So when we come back, speaking of opportunities, Simon's going to go through some of the ways he screens for these hidden gems and looks for opportunities. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure-play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome back to the Investing with IBD podcast. It's Justin Nielsen, your host, along with Arusha Paris, who joins me every week. He's a portfolio manager over at O'Neill Global Advisors. And we also have returning to the show, Simon Erickson, founder and CEO of 7 Investing. He's been on a number of times, and each time he kind of gives us a take of looking at those fundamentals, really kind of diving deep into what is making the story behind some of these stocks. So maybe the VHS behind the music type situation here. So Simon, when you're finding out all of this stuff, and let's also just remember, you have an engineering background, if I'm not mistaken, right?
That's right.
So when you kind of get into the weeds, you really can get into the weeds on some of this tech stuff. But how is it that you find these names? What is it that you're doing to uncover these stories? And how much work are you putting into kind of the valuations and all of those things?
Getting into the weeds typically means people's eyes start glazing over and checking out when I get into the trenches of the podcast. But
Okay.
it's trying to, you try to find these big trends, right, Justin? What we try to do is look for the biggest opportunities, in my opinion, in the market happen because there's a long-term trend that's developing, and there's a certain subset of companies that's taking full advantage of that. And if your ears are ringing from hearing too much about NVIDIA or Tesla or all these other companies that just seem like they're in the headline all the time, it's kind of interesting to kind of peel back the onion to a second layer and say, yes, those companies are great. Yes, NVIDIA is up 190% this year. Yes, Tesla's up 119%. But perhaps there are other companies that are not so followed all the time. They don't have so many analysts following them and so many price targets that are similarly going to take advantage of kind of these cyclical trends or these long-term just disruptive trends that are out there. And I think that maybe the fun part for me of investing is to go out there and look for some of those. We chatted earlier in the program about kind of the strength of the NASDAQ, and we see some real important trends that are developing out there. Maybe let's start discussing some of those hidden gems and why actually they might be the next generation of winners here in the next couple of years for investors.
So Simon, I guess the one question is, how do you stumble onto some of these? Are you just going through the value chain, the supply chain here, and going and trying to figure out, okay, what companies are working with NVIDIA, or whatever other big companies, or what new products are there, and what components are part of it?
It's kind of a three-step process, Arusha, for finding a big trend and then riding the wave or taking the elevator to the top floor or riding the S-curve, pick your analogy for it. But kind of the first one is it the right trend? We say that, but there's been a lot of times we see a lot of things that convince us. The hype cycle's job is to convince us that everything is the next big thing. Doesn't always work out that way. Right? 3D printing did not actually put a 3D printer in everyone's living room, right? Cannabis did not get all of us high all day and then all night, for every single day. Commercial drones, are still not replacing to a large scale the Amazon vans that are driving around. Now, it's not to say those trends won't eventually be very big, but it does seem like sometimes things get overblown out of proportion. But then on the other hand, there are some very important trends, certainly the internet, cloud computing, and now AI. You see the impact on the mass market. And those are the trends you want to go after. Pick the right trends first and foremost.
Just real quick, how do you know? Because again, sometimes, as you said, there's kind of that hype that happens. So I guess what elements do you have to tell you, oh, you got into something that's hyped versus, oh, you got into something that has some legs to it?
And it's crossing the chasm, right? Somewhere on the back there is The Innovator's Dilemma, by Clay Christensen. But it kind of, shows that there are early adopters, techies that are going to get super excited about this thing that they're playing around with as a prototype in their basement. But then to really get into the mass market, it's got to have appeal for everyone. Right? You see electric vehicles doing that right now. You see AI, and Microsoft's products doing that right now. When you get to that kind of momentum where it's got legs to it, that's where you can kind of separate out. Yes, this is kind of exciting. You talk about it at a trade show at CES versus this is something that's touching my life and everyone else's on a daily basis.
Okay. So I interrupted you. You were going to go to step number 2.
Step number 2 is do not compete against the 800-pound gorilla in the trend. If Arusha and I want to go start a business today and we say we are so excited, we are going to go compete directly against Elon Musk. Probably the worst business idea ever, right? You want to find ways to complement the largest players in the trend. It's good if you can go do something that Elon Musk cannot do. It's even better if you can do something that he really needs help doing. And so that's kind of the picks and shovels angle that we'll take here today is, don't go head to head and try to squash companies with larger resources and more employees and more dedicated R&D and things like that. Find ways to complement them and ride that same wave as they go out and they develop the market and get a lot of people excited about it.
If you can't beat them, join them, right?
Absolutely.
Okay, and the third step.
And the third one is follow the money, right? You know, the kind of the old saying of great success comes from 10% inspiration and 90% perspiration. You know, execution is everything. It's one thing to have a really neat idea. It's another one to capitalize on it, get a lot of funding behind you, get a lot of the right people on board, and then, you know, kind of execute according to your long-term strategic plan. There's a lot of great ideas that don't go anywhere. And then there's a lot of great ideas that can last for decades. And so if you kind of look at the momentum that some of these early companies are building, don't just say, oh, that's kind of neat, oh, they got a great CEO or whatever it might be. Follow the money. Are they attracting a lot of venture capital? Are they attracting a lot of individual investors, institutional investors? They're going to follow the best ideas and push them forward to be more successful.
Mm-hmm. Right. So maybe you could give us kind of a little case study and walk us through, you know, a real life example of how you might approach this with your 3-step process.
So a great example of this one is Supermicro Computer.
Okay.
Supermicro is a moniker they prefer, and then SMCI is the ticker that's on this one. Justin, this has gone gangbusters in the last year or two.
Yeah, I'm not sure this qualifies as a hidden gem because it's like, wow, you know, looks like some people might have discovered this one, right?
And 2 years ago, it was a hidden gem, right?
Absolutely.
You know, when AI was just kind of becoming into the limelight, and everyone was paying attention to NVIDIA and everything that Jensen Huang was saying, it seemed like the more times you said AI in your conference call, the higher your market cap went every single minute, right?
Yeah.
But you know, and we talked about the chip makers. You know, NVIDIA is designing the chips, AMD is designing the chips. You and I have chatted about the chip manufacturers, the Taiwan Semiconductors of the world that are actually, you know, got the volumes and the production lines, and they're producing them. But the hidden piece, the missing piece here was what Supermicro did, was actually installing them into the servers. Mm-hmm. Right. So you've got all these data centers, you've got all these cloud data centers, you've got corporate data centers. They want to use those processors, but you can't just look at a microprocessor and say, what am I going to do with this right now? It took expertise of a company like Supermicro, who knew how to actually, you know, compile those chips, organize them with other types of chips, put together the power, the cooling, you know, get them installed in the server racks. And that's not as easy to do as it might initially sound. There's a lot of expertise that goes into that.
Yeah, but Simon, that kind of sounds boring.
Right.
Mm-hmm. And it was, you know, for a lot of these companies, they didn't want to focus on those things, and so they turned to Charles Liang, who's done this for 30 years, and he worked directly with AMD and directly with NVIDIA, and he said, "Hey, I've got the relationships with the big tech companies that have got their own data centers. I've got the relationships with you, NVIDIA, who wants to get in with these guys. Let us bridge that gap and make it as easy as possible within a couple of weeks. When you release a new microprocessor that you're really excited about, let's go get into the data centers." And if you've looked at data center growth for GPUs for NVIDIA or the EPYC CPUs for AMD, shooting off the charts, just like this stock price chart has been shooting off the charts. Good reason for that. They rode the trend and they enabled it for the biggest players.
Mm-hmm. So kind of going back to your 3-step process, you know, if you had identified the trend and who some of those big players are, this is kind of, hey, how do I complement them? How do I work with them in order to kind of produce those win-win situations, right? We're going to win because we're doing business with you, and you're going to win because we're getting your stuff out there quicker maybe than you could, letting you concentrate on your part, and we're taking over this part for you.
And the techie eyes glazing over engineering part that I'd like to show. I have 23 graphs I'd like to show now in the program, Justin. But right. For anyone listening, not really going to do that to you. But the thing that was interesting was that the engineers were saying, hey, too much power consumption for these GPUs, right? These are awesome. They can do AI. You can do everything you want to, but it's too much operating costs because they're using way too much power. And so Supermicro jumped right on that, and they said, you know, what if we could configure them differently? What if we get the most efficiency in terms of watts of power per trillions of operations per second that you're executing on these things in a way that gets your operating costs down and the performance that you're looking for? I mean, that alone has gotten this business a ton of revenue over the years.
Well, how much is that of that started earlier? I don't know the full story behind that, but that seemed to be when you talk about that problem, that seems to be like what was behind you know, the blockchain, you know, problem with, hey, you know, the more you're mining, you know, I mean, it was one thing when it was a little bit easier, but as these problems get more complex, the computing power that's required, you know, now you're leaving a footprint on the power grid.
It's incredible. You look at the percentage of the world's power that's just going to data, you know, to computing stuff in corporate data centers, and it's becoming so complex now, right? Intel did this with CPUs in the data center back in the 90s. And then all of a sudden we started introducing GPUs in the data centers in the 2010s. And now you've got like these complex configurations of NVIDIA's H100s with some other CPUs on the side that are working together to modernize your data center, or, to get zero latency for the metaverse. I mean, it's almost mind blowing to keep up with it, especially with the innovation pace of this industry. Unless you've got 30 years of expertise doing this and right like the back of your hand how to configure these things. Interesting trend and interesting use case for Supermicro there.
So Simon, who are the competitors for a Supermicro? Are there any other kind of smaller kind of competitors like this, or just maybe some of the larger kind of names?
Globally, in terms of server infrastructure, they have about 5% market share. The largest player in this market is Dell, who only has 17% market share.
Wow, that's
and then Hewlett Packard Enterprise is the other large player with 15%. So very, very fragmented, Arusha. It's been a tough market to make any money in. That's kind of what the market you want to play in if you're a kind of an up and coming company that's still very small.
It's so funny because when you were talking about what Supermicro does, it reminded me of Dell making these computers in his college dorm, and getting them out, or Hewlett and Packard, doing it in their garage, right?
Yeah.
So those were 90s concepts, and here we are, full circle, kind of doing it again, but with different components, more powerful components, and trying to solve different issues, as opposed to getting that computing power more available to people. Now it's getting that computing power cooled down and working efficiently. Kind of like what you went into this so much about electric vehicles in a past podcast. It's about getting that power, to the engine, right? And it sounds like that's what we're doing here for the AI.
And there's an even another complementary trend on top of everything we just talked about, which is ESG right now. Justin, you pointed out the energy efficiency. That is a really big trend that is getting a lot of investor attention right now. And if you ever listen to an investor presentation from Supermicro, they're quick to point out, we think that we've saved our customers $10 billion in cost savings from using less power. But hey, also that $10 billion that they've saved, that has the amount of power that we required for all of that would have been 30 fossil fuel power plants. I mean, they know what they're doing and how they're crafting the message too, because you're saying, hey, less power, but that's also good for the environment. It gets a lot of ESG attention right now.
Are they being recognized for that? Like, do they get a high ESG rating because of this?
Absolutely, and that's becoming more and more important. We actually just chatted about kind of disclosures and climate change and kind of a lot of that with Seven Investing here this past week. Super important right now.
Now, Arusha, you've kind of gotten a little bit more onto the analyst side, not just a portfolio manager, but also an analyst. How much of this digging kind of thing, how much of this process is something that you can readily do yourself? Is this something anyone can do, or is this really specialized to Simon only?
Well, I mean, it's
understand this stuff, right?
Well, I mean, Simon kind of said it right there. I think for anybody, they can always go to the investor presentations and listen to the conference calls, and in many ways, that's the best source of information, because you're hearing it right from the management, how business is actually going. So that is definitely a good way. Now, even for us, we have a team, right, of analysts who will do digging on certain points, and they are specialized. So we've actually for Supermicro, we have been watching this for quite a while, and Romeo, our semiconductor analyst, has been talking about this really over the last 6 months, and it always kind of, I mean, it sounded interesting, but it also kind of sounded boring. But with the way how strong the stock, really, this was one of the first stocks to hit new highs right at the beginning of the year.
Yeah.
Right. And it just refused to correct. And it was just always hitting new highs. And it was that bucking bronco. And so once the market pressure, the overall larger market pressure kind of released, it's not necessarily too much of a surprise that this is taken off. The problem is it's just really hard to get in and manage your risk if you weren't really Johnny on the spot for this one right when it started going.
Mhm. Now, Simon, I got another question for you because looking at the numbers here on the fundamental side, a lot of times we look at that growth of the earnings and of the sales, and SMCI had that in spades. It just, I mean, quarter after quarter, triple digit earnings growth, double digit sales growth, and these were not small numbers. I mean, this was, 1.6 billion, 1.8 billion. But then do you have any idea what happened this last quarter? I mean, it certainly didn't seem to phase the stock. The stock still went up on this last earnings report, but it went from triple digit to 5% earnings growth and negative 5% on the revenue growth. Any idea of is the party over?
The party's not over, but the biggest drinkers at the party are slowing down a little bit.
Okay.
They did have one undisclosed customer. It's either Apple or it's Meta Platforms, Facebook, that was 22% of revenue in the best, most festive part of the party that was going on, right? But these things kind of happen in batches, right? It's not just continually. You're always installing new chips. You might go out and say, okay, we're going to spend this much money this quarter on data center retrofits, or we're going to upgrade. But sometimes you see a little bit of lumpiness in a quarter to quarter, depending on the capex that your biggest customers want to spend. But then complementing that too is, I don't think that GPT is going away anytime soon. I don't think Bard or Llama or any of these other large language models are slowing down. It actually seems the opposite. Like corporations are finally embracing those. And if you do that, you've got to have the right processors and the right installations into your data center to keep up.
Yeah, it's funny because I was chatting with my cousin who is a professor over at in Colorado Springs, and he's going to be doing a class a little bit on using Chat GPT for writing. And he was saying that he's not actually using the paid product right now because it's changing so fast. He doesn't want to learn it until right before he teaches the class,
That's interesting.
because there's so many new features coming in. He's like, I don't want to really waste my time too much on something that's going to be very different by the time my class starts in the fall. So, yeah, very, very, very big on a lot of changes happening. So, any final thoughts, Eric, Simon, on your process here? I was going to call you Erickson.
Well, Nielsen, I do. My final question is Neil. I mean, Justin. It's got to be. You kind of look at the OEM revenue of Supermicro. Not to get too into the weeds, but look at those big 22% kind of customers, because they're going to be the first ones that are going to embrace the newest, the latest and greatest processors that AMD puts out and that NVIDIA puts out. But then the rest of the market's going to try to keep up with them too, right? So part 3 of that 3-part process is you got the innovators, enable the innovators, and then watch the execution for the layer that's more of the mass market. I think that we're going to see a lot more of that with Supermicro, and they're going to add a lot of headcount to their organization in the next couple of years.
Okay. Well, thank you for diving into that case study for us. And when we come back, we're going to talk about how this same process might be used to uncover some new hidden gems that aren't sticking up hundreds of %. So stay tuned. We'll be right back. The Direction Hydrogen ETF offers exposure to the top 30 pure play hydrogen economy companies by largest market capitalization, leading the way towards net zero emissions by providing more accessible, efficient, sustainable solutions across 5 hydrogen-related subthemes. With clean hydrogen-based energy expected to grow 5 times in the next 30 years, companies building hydrogen-related businesses to generate power, heating, transportation, and more will likely thrive. Welcome to the Investing with IBD podcast. It's Justin Nielsen, your host, and we have Arusha Piras, O'Neill Global Advisors portfolio manager, who joins us every week. And our special guest this week is Simon Erickson, who is, just really kind of letting us know about what's happening in AI. We have to mention it 5 times at least, so Beetlejuice appears or something like that. But he, of course, is the founder and CEO of 7 Investing, and he just kind of told us about his 3-step process for finding these hidden gems, finding the trends, and really kind of finding those stocks that will benefit from the trends, but not necessarily compete against the big 800-pound gorillas. So, Simon, what other trends can you share with us, and some of the stocks that might be uncovered with this process of yours?
Okay, well, Justin, I'm done talking about AI. We've beaten that.
We're going to move on, huh?
Right.
But we'll probably throw it in 5 more times.
Thank goodness. Thank goodness.
Yeah.
I hope so. Yep.
Yeah.
It's time for another 2-letter acronym, which is EV.
EV. Okay.
Right. Okay.
This is one I'm not familiar with. No, I'm
That's
just
right.
kidding.
Another overused two-letter acronym, which is electric vehicles, EVs,
Yeah.
is another one of these trends that really has got legs. Yeah, it's every automaker now has pretty much embraced these and is rolling out the next generation of their own electric vehicles. Certainly in response to Mr. Musk, the cage fighter that has become so popular globally. That is, Tesla is certainly the leading global automaker, at least in brand recognition for EVs, and it's prompted everyone else to follow suit. And there's an interesting kind of sub-segment of this market that isn't quite as followed. We know that the lithium-ion batteries and everything that Tesla's doing, but it's kind of interesting because this is a completely different supply chain than the auto industry has gotten used to. You now have a battery that is feeding the power to the vehicle rather than a gas-powered engine. Right. And that has some interesting complexities, one of which is you've got to convert the DC power that's produced by that battery into the AC power that would be required to turn the motor. And there's a component in that called a traction inverter, which does that conversion. You want it to be as efficient as possible. And the rabbit hole I'm leading you into here finalizes with the important context here that if you used silicon carbide material instead of just regular silicon for the chips that are going into the components that are going into that traction inverter, you can actually get 15% longer range out of your car, your electric vehicle, than if you're just using silicon base. It's a wide band gap material is the important one here. And so Tesla did that. They used silicon carbide. It's in the Model 3. It's out there right now. And now all of the other global automakers are saying, we're going to follow Elon's lead on this. We think he's a pretty smart guy. Where can we get security of supply of silicon carbide? And that's exactly what Wolfspeed is doing. They're building not one, not two, but 3 global manufacturing facilities to produce the silicon carbide wafers and also the finalized components. And they're announcing new deals every month with the global automakers that are just as excited as they possibly can be to roll out next generation electric vehicles in the next couple of years.
Now, Simon, why has the stock been struggling then? You have
That's exactly what I was going to say.
It's pretty amazing, because when you see Tesla doing so well and a lot of these other growthier type of stocks doing well, and Wolfspeed went along with Tesla back in 2020. What's the difference between that and the previous trend, or the current trend and the previous trend?
There's 2 answers. The first one is that Elon has wielded a double-edged sword. Live by Tesla, die by Tesla. It was great when Tesla came out and they said, we want to buy the silicon carbide materials from Wolfspeed. We're going to put them into the Model 3. At their presentation earlier this year, they revealed they're going to cut back on the silicon carbide content in their next generation vehicles by up to 75%. Now, there's an interesting context in that. Of course, that caused the stock to sell off. Nobody wants to hear your largest customer is cutting back on their usage, but it's also likely they were using too much in the first place. And the new designs that they have for a more mass market affordable electric vehicle that Tesla wants to introduce would be more on par with what Wolfspeed is working with other automakers today. So the Model 3 is still going to continue to use what it's using. It's still globally selling very well. So Elon is one part of that too. The second is this is a investment cycle for Wolfspeed. They're spending a ton of money on those facilities. And of course, there's going to be hiccups along the way when you're spending billions of dollars in North Carolina, in New York, in Germany, all across the world. You're going to have your hands full, and there's going to be a lot of money you're going to have to spend on that. And there's going to be some speed bumps. There's going to be some hiccups along that way. But typically, when you're investing very heavily, you're going to harvest that in the next couple of years. That, in my opinion, is when the market is going to properly recognize the success and the innovation that Wolfspeed's been doing. So still might be a year or two out. It might not happen this quarter, next quarter, but certainly some great long-term trends that they're riding here.
Yeah, that makes sense.
Now, what happens, again, when you become dependent so much on a single company to kind of produce your revenues, and you kind of hinted at this with SMCI. Some unknown customer changed their CapEx spending, and that had a big impact. So I guess, since you don't always know the workings of behind the scenes what's happening, how do you kind of protect yourself from that single customer risk?
You sign contracts. You lock in your customers to supply contracts where you say, okay, if we're going to build this, you've got to take what you're telling us you're going to spend the money for. Because if you're not, then we've got to use it for somebody else that wants to have the security of supply. And that's exactly what Wolfspeed's been doing. They try to make it hard to, phase out their materials. You try to lock them into supply agreements. A lot of their customers have actually given them financing to build, the CapEx required to build those production facilities. But if you're an automaker, you don't want to go shop around. You want to find somebody that's giving you an acceptable price point, and then you're going to get that every single month to manufacture your cars. Otherwise, you got a lot of uncertainty, and that's really bad when you're trying to roll out new vehicle lines.
So what do you think is the catalyst here for the stock to kind of turn around? I mean, it's certainly had a strong move off of its bottom so far, but whereas now, so many more stocks are above their 200-day moving average lines, above their 50-day moving average lines, whereas before, I mean, it was like dismal. Everything was below those long-term moving average lines. Now, Wolfspeed is kind of among the minority in terms of being below those lines. So what do you wait for to show that things are turning around for it, or do you just kind of buy it low and hope?
Yeah, there's a couple things. I mean, just I'm looking at the chart that's up right now that it shows Wolfspeed's market cap of $8 billion. And they've put publicly, they've made statements that they're expecting, I believe the number was $4 billion in revenue and a 20% operating margin by 2027, fiscal 2027. So still a couple of years out. Got to get those new facilities they're building to start producing the volumes. But if that's true, where you're actually producing $800 million in operating income that's recurring, and you're only at an $8 billion market cap today, the stock is completely mispriced. There is no credit being given to what management has been very comfortable enough to say publicly that they think they're going to do. And again, a lot of that's not just throwing darts. You've got long-term contracts to support it. I think that the catalyst is when you actually start seeing these facilities hitting the strategic goals, of getting them up and running in time. Like I said, it might not be exactly by the month that they initially had said, but as long as they're getting them online and they're actually manufacturing the new wafers, that's going to be a lot of optimism, in my opinion, from the market.
Very good. Well, let's go ahead and shift gears a little bit, and let's talk finance. Now, we've got a lot of banks that are going to be kicking off earnings season coming up, and then also not just in the financial, the bank sector, which definitely got hard hit in March, especially those regional banks. But what about with trading? Let's take a look at CME Group, and what is it about this company that is intriguing to you?
This is a very different one than Supermicro or Wolfspeed, right? CME is very established, not a small cap disruptor. This is a company that's operating some of the largest exchanges in the world. You can trade everything. You can trade eggs. You can trade Bitcoin. Whatever you want to, Justin. They've got ways to execute those contracts. And the thing that's interesting to me that I like about this one as a contrarian is we hear so much about rising interest rates and the macro working as a headwind to so many companies. Interest rates are going to make your capital more expensive. You're going to have to pull back on the accelerator of your growth plans. You've got to lay off employees, whatever it might be. Those same macro-related trends are actually a huge tailwind for a company like CME Group, who's trading the contracts so that companies can hedge their bets. They can actually make money speculating on the future price of the 2-year treasury or the future price of Bitcoin or eggs or whatever they're wanting to bet on. And when you see something like the options related to the 2-year treasury up 877% year over year, it shows that speculation that's driving the average daily volumes of this business to new highs every single quarter, right? And so what I'm looking at, you kind of see in these 13 million average daily volume contracts for CME Group in the most recent quarter, kind of hitting new highs in a lot of those areas that they've traditionally served. And then some new ones like the crypto, as they're keeping up with how markets are changing out there. It's kind of a nice contrarian play that if you want to get away from the volatility that's punishing so many of these companies, this might be a way to hedge your own investment risks by investing in a company that benefits from them.
Right. And I mean, certainly,
this has like a beta of 42. So it's pretty amazing at how low volatility. I remember CME being a much more volatile stock in the past.
It's fat and the leverage too, Arusha, right? Like revenue was only up 7%, but earnings per share were up 25%. You can see that even just a little tick up with an efficient operator like this can fall to the bottom line very quickly.
That's true.
Well, it's funny how it seemed like, gosh, what was it like almost 2 decades ago, where it seemed like a lot of these um, market makers and the exchanges started having IPOs of their own, right? I mean, I
Yeah.
remember you had ICE, you had CME. I feel like you had some of the specialists even coming public. But I guess after that initial really strong move. And I mean, CME. If you look at the monthly, you can just see this nice steady move. Um, over almost the last decade.
Hmm.
And then before that, I mean, in 2002, I mean, it just skyrocketed, and it wasn't alone. I mean, there was ICE, Intercontinental Exchange, and again, a lot of these players that did very well. So now that they're, I guess, a little bit more mature, what's the expectation of, I guess a lot of times we're looking for that new thing, right? Now it seems like old stuff. So what's new here though?
Bitcoin volumes were up 22% year over year. That's kind of, financial markets are changing. We're still trying to figure out cryptocurrencies. Speaking of hype cycle, I think they got a little overhyped there a couple of years ago. You remember it, I'm sure, Justin. Everyone was talking about Coinbase, and everyone had a crypto token. I think there was an Arusha coin at some point in there. I don't remember. But it calmed down a little bit, but you can still see the speculation. If you want to hedge bets where, if a price of Bitcoin falls, you've got to hedge that in a certain way. If the price of oil goes up, you want to hedge that. If the price of whatever it is that is impacting your business, you want to hedge that away. And I don't think that CME is going anywhere. I just think that it's a contrarian bet right now for investors to
Yeah.
make.
And that's the big thing. That's the new. It's that condition in the industry, which a lot of people forget that it doesn't have to be a new product. I mean, heck, there were, when fertilizers were having their run. It's not like fertilizer's new, right? It was a condition in the industry that was driving it. Okay, let's go ahead and go to our last stock, and it's an old favorite that's starting to get people's attention again. Upstart, ticker symbol UPST. Um, is this? Can we throw AI into this one, or?
I hope so. It's been at least 3 minutes.
I know. I feel like it's been a while, but what's going on with Upstart, and did it get overdone on the upside and the downside? What's happening here?
Well, look at this mountain for skiers right here, Justin. Look at the chart.
Yeah.
I mean, I mean, you're going straight up. Right when it came to the public markets, there, late 2020, kind of early 2020, when you see it going from $20 a share up to $400 a share, right? You take the gondola up, you take the ski lift up to get up the mountain on that one, and then you fly down the other way as it's going from $400 back
Black
to
diamond
$15.
skiing right there.
Right, fun to go downhill skiing. Not so much fun when you're losing money on it. But
Yeah.
certainly, this is a stock that got ahead of itself because of the status of the economy. When interest rates were zero and everybody wanted to borrow, volumes were, and apologies, a little bit of step back for Upstart. Upstart wants to replace the FICO score as using AI to deem the credit worthiness of people that want to borrow money. And so banks want to hire Upstart to go out and find people to lend money to, make sure that it's a good loan that they're going to be making, and then process it instantaneously, a matter of seconds rather than days or weeks. So it's kind of rewriting kind of the way that FICO and the traditional banking has done things. But again, go ahead.
Yeah, well, Simon, now one of the things, because that was kind of the exciting thing, is like they had this black box, and they could you could use like the Upstart credit scores to market to more people, and who weren't necessarily deemed credit worthy with FICO. And so, there's more loans and opportunities for the banks to make. But then, of course, then the whole black box thing kind of got criticized when it was falling apart. Has any of that changed over the last few months, where it's now starting to excite the market again with Upstart? Are they becoming maybe a little bit more transparent, or showing a little bit more proof that it's lowering the risk?
It's very highly correlated to the market, Arusha. This is one that they haven't lost their partnerships with the banks that they have, right? They're actually signing up a lot more. These kind of regional banks that maybe don't have the headcount or the manpower to build their own AI algorithms to find people. They'd say, hey, I'd really like to hire you, Upstart, to do this for me, and I just want to make sure you're giving me really good loans. And so the first really good metric is you're getting more and more partnerships, more and more credit unions and banks and things like this are signing online. And then the second is they've maintained their pricing, right? When you look at contribution margins of more than 40%, even in the down part of the cycle, banks still see value in paying them the couple $100 per new loan. So that's really encouraging too. It's just been a factor of fewer loans because the macro has been suffering here. And I think that's what's going to turn around here. I think that's the key for Upstart is they've got a valuable solution. It just was very highly exposed to the macro. And even interestingly too, this is another contrarian opinion on this, but I think that a lot of the things that we have associated as headwinds that would work against Upstart are hidden tailwinds that would actually benefit this company in the long term. You think about the economy, challenging time for the macro, right? People are getting laid off, interest rates are going higher. It's maybe people don't have full-time jobs that you need to check those checklists for a traditional bank or a FICO score, things like that. Maybe people now are working gig economy jobs. Maybe they're doing just fine in terms of income, but they don't have the most important things that FICO would ding you for. And so even as the economy is changing and people are finding new opportunities out there, that could be a hidden blessing in disguise for a company like Upstart, which is rewriting its entire way of deeming the credit worthiness of borrowers. Kind of an interesting out of the box way of thinking about it, especially as the economy improves. And maybe, just maybe, this becomes the new way that we get an auto loan or a home loan or any kind of loan that we want to borrow. It could be a super automated way of doing it in seconds rather than days or weeks.
Mm-hmm. So when you were talking before about kind of your process and not getting into the cage match with Elon Musk or whatever 800-pound gorilla that you choose, not meaning that Musk is an 800-pound gorilla, so don't.
No,
don't
that's
come
going
after me.
viral now, Justin.
Yeah,
That's going
don't
viral.
at me, Musk. But are they coming after FICO? Is FICO the 800-pound gorilla that they're jumping in the cage match with and saying, hey, we've got something better and we're going to try and replace you?
And they are, to be clear, Justin, but I would spin that just a little bit that they're partnering with the banks because the banks are their partners. And they say,
the banks are the gorillas.
They're
the ones that
they're
pay
not
the
trying
money.
to be a bank. And Upstart doesn't want to be a bank. They don't want to go out and originate their own loans. They want to say, we want to make this easier for you to do it on your own. We want to be a partner that goes out and originates. And then you're the one that figures out, you want to keep that loan on your balance sheet. Do you want to sell it off to investors? Choice is yours. We're going to pass the torch to you to figure this one out. We just want to be your partner that gets you better loans and then the door in the first place.
Mm-hmm. Well, this has been great stuff, Simon. It's always a pleasure to have you on. And, just for folks that maybe aren't familiar as much with your stuff, you're on Twitter, right? At 7Innovator, and that's the number 7Innovator. Where else can people find information about kind of your analysis here, Simon?
Yeah, thank you, Justin, for the opportunity to be on the show and also to chat just about it. 7investing.com is our website. Every month we make 7 stock recommendations. And we've lowered the bar as much as we possibly could to get people in and looking at those and interacting with our site. It's a $1 trial to get started. And then, our normal membership for the year is $299 a year. But for Justin, for you and Arusha, I've used promo code IBD that would get you $100 off in perpetuity. Awesome. 33% discount for anybody who uses IBD at 7investing.com/subscribe.
Oh, very good. Okay. Well, again, for people that, really like the way that Simon, gets into those weeds, and I'm sure you probably have some of those 23 charts that you mentioned on your website to share with folks. So,
well, and Justin, and very quickly, it's not just written information, right, Simon? There's videos there of your whole team discussing and debating ideas, which I thought was pretty interesting. So there's a lot of value there, especially for that price.
We have cage matches, Arusha. Just as much as anyone, we do cage matches to fight it out for the what stocks we pick. But we are very interactive, right? We're a mission-driven company. We want to empower investors to make better decisions, and that includes subscriber calls where we talk on video live with them. So we're having a lot of fun. We're really enjoying the journey here.
Awesome. Well, thanks again for being here, Simon. Always a pleasure.
Thanks very much.
Okay, and on the show next week, we're going to have Tom Sosnoff. Now, for those of you that aren't familiar with Tom Sosnoff, he is, he's someone that I admire a lot. We've seen him at money shows. He, started up Thinkorswim, Tasty Trade. He is just the serial entrepreneur that has done so much. So we're going to be getting some insights from him. Probably talk a little bit about the options market since he is an absolute genius in that regard.
Yeah,
So
Justin, you're going to have to promise all of us not to geek out too much on the options with Tom.
right,
Okay.
okay,
I mean, let's
yeah.
keep it at a level that I can understand. That it is. We're very excited to have Tom next week, but I don't want you guys going too far in the weeds, here.
Yeah. Okay, we'll try, but no promises. So definitely tune in for that. Thank you so much for tuning in this week, and we'll see you next time. Take care.